Today we're sharing what fixed income investing is and what role it plays in a portfolio.
We are DIY investors who have experimented our way to a fixed income investment strategy that works for us.
Stay with us till the end of the episode to find out why fixed income investing might not be right for you.
A big hello and welcome back to all of our subscribers. If you're new around here, I'm Stephanie.
And I'm Gillian. We're a couple who saved and invested for many years until we finally reached financial independence. If you're looking for how-tos on financial independence and retiring early, you can hit subscribe for a new video every Thursday.
We recently shared a video that gave all the details of our strategy for investing in the stock market. You can check out the video in the link below. In that video, we talk all about the investing mistakes that we've made, we talk about how we fine-tuned our strategy over the years, and finally, we share exactly which investments we hold today.
That video covered our equities, and afterwards we got a lot of questions about the fixed income side of things. So during today's video, we're going to share exactly what fixed income investing is and what types of investments we hold.
A quick disclaimer here, we are not investment advisors, we're just sharing our own approach, what works for us and our risk tolerance.
As a refresher, our investments are a mix of equities and fixed income. For equities, we hold a low-cost index fund, which gives us a slice of the overall global market.
For fixed income, we invest in syndicated mortgages, which give us regular interest payments. This is what fund our day-to-day living expenses. Before we jump into it, a question for everyone who's watching. Do you hold any fixed income investments? Yes or no? Let us know in the comments below.
Let's get into this topic, starting with what fixed income investments are. These are investments where you loan your money to a third party in exchange for an agreed upon rate of return, or interest payments. This is different from investing in the stock market, where you're investing in an asset that can increase or decrease in value. During times when there's economic growth, like the last decade, your investments can increase significantly on the stock market. But they can also decline in value during periods of recession or market volatility.
So you never really know how much growth or loss you're going to see by the time you're ready to cash in your investment. That said, the market has been shown to grow over the longer term. So basically, you're making a bet that you're going to see a decent return.
So the key difference, with fixed income investing, you generally know how much you're going to make. With the stock market, you don't know how much you'll make, but you expect to come out ahead in the long term.
There are many types of fixed income investments. We're going to spend some time talking about a few of the most popular ones. The most basic type of fixed income investment that you can get is one you can just walk into your local bank and get very easily. So these are called certificates of deposit in the US or guaranteed investment certificates in Canada.
Although the rate will be better for a longer investment, typically the rates are not all that high. Right now, you might be lucky to get a couple percent or less.
Another common type of fixed income investments are bonds. Traditionally, bonds would be purchased through a broker, and whether they're corporate bonds or government bonds, the idea is a loan for a specified period of time at a fixed rate of return.
These days, many people invest in bonds through mutual funds or exchange-traded funds. These funds aim to track a bond index, which could be comprised of government bonds or municipal bonds or corporate bonds, just to name a few.
Generally speaking, bonds are a lower risk investment and also a lower return investment versus equities.
Moving on to another popular type of fixed income investment, which are annuities.
With an annuity, you would start by depositing an initial large sum of money, or you could break it up into a series of payments. You are then guaranteed regular payments later in life, such as when you turn 65 and you're ready to retire.
The rate of return on annuities will generally be even lower than a similar investment into bonds. That's the price you pay for getting someone else to do your investing for you.
The next type of fixed income investment is a money market account, which are available from banks and credit unions.
They do pay a slightly higher interest rate than a typical savings account, but usually a higher balance needs to be maintained.
Now, there is a fifth type of fixed income investing that we wanted to talk to you about today. This is called private lending, and it's actually the kind of investing that we do. But before we get into that, we wanted to also talk about the role that fixed income investments can play within your overall portfolio. Fixed income investments do provide a number of benefits. So while they don't see the returns that you would get from equities, they also don't have those highs and lows you get from riding the stock market. So having some fixed income in your portfolio will definitely help even out some of that volatility.
Fixed income investments also pay out regularly. With all of the examples we talked about, they provide a regular income stream throughout the life of the investment.
Finally, because the returns on fixed income investments are not directly correlated with the stock market, you're adding some diversification to your portfolio. Essentially, you're not putting all of your eggs in one basket.
These are all components of a financial risk management strategy, which we talked about in a recent video. We'll link that up in the description below.
Now let's talk about some of the considerations that you might have when deciding how much of your portfolio should be allocated towards fixed income versus equities. Ultimately, the amount that you allocate is a very personal decision, and it's based on your own circumstances and your own risk profile. However, we do have a few considerations for you to think about.
You would want to consider including fixed income investments if you're uncomfortable with the risk and the emotional roller coaster of a 100% equities portfolio.
You would also want to consider fixed income if you have a need for an investment that would give you regular payouts and you feel that stock dividends wouldn't be quite enough to meet your needs. This was a very important point for us when we were planning for our retirement. So we really wanted to have an investment vehicle that would give us regular payouts every single month that would effectively replace our paychecks. And we talk about this in a recent video, which we'll link up in the description below.
And one last reason why you might want to invest in fixed income is if you need to access your funds within a shorter time horizon, such as 5 years. Fixed income will definitely give you back your original investment plus interest within 5 years, while equities may or may not.
Now we'll share exactly what type of fixed income investments we hold. We've already taken you through 4 types, so this is the 5th, which is private lending.
We invest in syndicated mortgages as a type of private lending. These are construction loans, whether residential or commercial, that are split up between many different lenders. So we invest in a tiny piece of a mortgage, sometimes just 1 or 2%, and we've built up a whole portfolio of these type of mortgages.
You might be wondering why we like this type of investment. Well, for us, this gives us exposure to the real estate market without all the complexity of owning property for ourselves. Additionally, the yield for this type of fixed income is much higher than something like bonds.
Of course, higher returns usually come with higher risk, but there are some ways that we can manage the risk. The loans are always backed by a property asset, so we do have that reassurance in case the borrower defaults. We also choose to only invest in first mortgages, and for those mortgages to be less than 75% of the property's value.
To be honest, the type of investing that we've just described is really not suitable for beginners, and this is because you need to bring a level of due diligence when evaluating the different loan opportunities. However, if you are interested, there are mortgage investment funds which provide a more passive form of this type of investing. So we've just spent this entire video telling you about all the benefits of fixed income investing. Now we're going to tell you why you might not want any fixed income in your portfolio.
If you are more than 10 years away from retirement, you're probably best off focusing on your wealth accumulation and growth. So this means having a large proportion of your holdings in equities where you'll see the greatest potential for growth.
Fixed income investing usually has a larger role to play when you're more concerned about wealth preservation than you are about wealth growth. So in our case, we have a large proportion of our portfolio in fixed income investments, and that's because we've just retired. So we're very concerned about minimizing all of our risk over the next few years. If you found this video helpful and now you want to learn more about how we invest in equities, we recommend you watch this video right here. You can go ahead and click on it now.
If you enjoyed this video, you can give us a thumbs up, and don't forget to subscribe so you don't miss our next one. Thank you so much for watching, and we'll see you next time.